What if everything you thought you knew about money was wrong? What if becoming wealthy had nothing to do with your IQ, your education, or even how much you earn? Here's a mind-blowing fact. Ronald Read was a janitor and gas station attendant who never earned more than minimum wage. When he died in 2014, he left behind an $8 million fortune. Meanwhile, Richard Foscone was a Harvard-educated executive at Merrill Lynch who earned millions in salary. He went bankrupt. How is this possible? Today, we're doing a deep dive into Morgan Housel's masterpiece, The Psychology of Money, a book that reveals why personal finance is more about psychology than mathematics, more about behavior than intelligence. By the end of this video, you'll understand the hidden forces that control your financial decisions, and more importantly, how to harness them to build real, lasting wealth. Let's get started. Here's the central insight that changes everything. Doing well with money has little to do with how smart you are and a lot to do with how you behave. Think about it. Finance is the only field where highly educated, intelligent people can fail spectacularly, while people with no formal training succeed beyond their wildest dreams. Why? Because a genius who loses control of their emotions can be a financial disaster, while an ordinary person with discipline and patience can build extraordinary wealth. Morgan Housel argues that we've been approaching money all wrong. We treat it like physics or mathematics, subjects with clear rules and right answers. But money isn't like that. Money is personal, it's emotional, it's psychological. Your relationship with money is shaped by your unique experiences. Someone who grew up during the Great Depression will think about risk completely differently than someone who grew up in the boom years of the 1990s. Neither perspective is wrong, they're just different, shaped by different experiences. This is why there's no single formula for financial success. What works for one person might be disastrous for another. The key is understanding your own psychology and working with it, not against it. Let's talk about something that makes people uncomfortable: the massive role of luck in success. Bill Gates is one of the richest people in the world. He's brilliant, hardworking, and visionary. But here's something most people don't know. In 1968, Gates attended Lakeside School, one of the only high schools in the world that had a computer. The odds of a 13-year-old having access to a computer in 1968? 1 in a million. That's extraordinary luck. But the story gets darker. Kent Evans was Bill Gates's close friend and classmate at Lakeside. He was just as smart, just as passionate about computers. Many believed he and Gates would start a company together. But Kent died in a mountaineering accident before graduating high school. Same school, same opportunities. One became a billionaire, one died before his life truly began. That's risk. Here's what Housel wants us to understand. Success is never as good or as bad as it seems. When you see someone succeed wildly, you're seeing skill, but you're also seeing luck. When you see someone fail, you're seeing mistakes, but you're also seeing risk that didn't pay off. This matters because of how we judge ourselves and others. When we succeed, we attribute it to skill. When others succeed, we sometimes attribute it to luck. When we fail, we blame bad luck. When others fail, we blame their decisions. The truth is always more nuanced. Acknowledging the role of luck does two things. It keeps you humble when you succeed, and it keeps you compassionate when you fail. It also reminds you that not all failure is created equal. Sometimes you make the right decision and still lose. That's life. The goal isn't to avoid risk entirely. That's impossible. The goal is to survive risk so you can be around long enough for luck to find you. Let me tell you about one of the most successful people who ever lived and how he destroyed himself. Rajat Gupta grew up in orphanages in India. Through sheer brilliance and hard work, he became the head of McKinsey & Company, one of the most prestigious consulting firms in the world. He sat on the board of Goldman Sachs, Procter & Gamble, and other Fortune 500 companies. His net worth, over $100 million. But it wasn't enough. He saw his billionaire friends and wanted more. So he got involved in insider trading, sharing confidential information with a hedge fund manager. He made a few million more, money he absolutely didn't need. He got caught, lost everything, went to prison, destroyed his legacy. Then there's Bernie Madoff. He was already wealthy beyond imagination from his legitimate business, but he wanted more. He ran a Ponzi scheme that eventually collapsed, lost billions of other people's money, and died in prison. Rajat Gupta and Bernie Madoff had reached the top of the mountain. They had more money than they could spend in multiple lifetimes, but they couldn't stop climbing. Why? Because the goalpost kept moving. Housel identifies this as one of the most dangerous traps in finance, not knowing when you have enough. There's always someone richer. There's always a bigger house, a fancier car, a more exclusive club. If you base your satisfaction on comparison, you will never, ever be satisfied. Here's the harsh truth. The only way to know how much is enough is to decide in advance. You have to define it for yourself. What does financial security look like for you? What does financial independence mean? Maybe it's $1 million, maybe it's $5 million. Maybe it's just enough to cover your basic needs and have some left over for experiences you value. But you have to define it, because if you don't, the goalpost will keep moving and you'll spend your whole life chasing something you can never catch. The hardest financial skill isn't building a spreadsheet or picking stocks. It's getting the goalpost to stop moving. It's saying, I have enough, and meaning it. Warren Buffett's net worth is over $100 billion. He's the most successful investor in history. But here's what's truly mind-blowing. $97 billion of that came after his 65th birthday. $97 billion after age 65. If Warren Buffett had retired at 60, almost nobody would have heard of him. He'd be comfortably wealthy, sure, but not legendary. His secret wasn't that he was a better investor than everyone else. His secret was that he was a good investor for a very, very long time. This is the power of compounding, and most people completely underestimate it. Compounding is when your money makes money, and then that money makes more money, and then that money makes even more money. It's exponential growth, not linear. Here's an example. If you invest $10,000 at 10% annual return, after 1 year you have $11,000, not life-changing. After 10 years you have about $26,000, still modest. But after 30 years you have over $174,000. After 50 years, nearly $1,200,000. Same 10% return, the only difference is time. Jim Simmons, the founder of Renaissance Technologies, has the best investment track record in history, 66% annual returns. That's triple what Warren Buffett averaged. But Buffett is worth far more. Why? Because Simmons didn't start his fund until he was 50. Buffett started investing at age 10. Time made all the difference. The problem is that compounding isn't intuitive. Our brains are wired for linear thinking. We expect steady, predictable progress, but compounding is exponential. It starts slow and then explodes. Most people give up during the slow part. They invest for a few years, don't see dramatic results, and quit. They switch strategies, chase hot stocks, or abandon investing altogether. But the magic happens to those who wait. The real gains come in the final years, after decades of patience. Here's the lesson. Good investing isn't about finding the best stock or the perfect strategy. It's about finding a good strategy you can stick with for decades. Time is the most powerful force in finance. Give your money time to work, and you'll be amazed at what happens.
This might be the most important distinction in the entire book. Getting wealthy and staying wealthy require opposite skills. Getting wealthy requires taking risks, being optimistic, and putting yourself out there. You have to bet on yourself, try new things, maybe start a business or invest aggressively. But staying wealthy? That requires the opposite. It requires humility, frugality, and paranoia. You have to accept that what made you successful might not keep you successful. You have to assume that the future will be different from the past. Let me tell you about Jesse Livermore. Livermore was one of the greatest stock traders who ever lived. He made his first $1,000 at age 15, By his early 20s, he was banned from most stock brokerages because he was too good at making money. He made millions during the 1929 stock market crash while everyone else was losing fortunes. He was a legend. But Jesse Livermore went broke, not once, but multiple times. He'd make millions, lose it all, make it back, and lose it again. Why? Because he could get wealthy, but he couldn't stay wealthy. He was brilliant at taking risks, but terrible at protecting what he'd earned. He kept betting bigger and bigger, assuming his streak would continue forever. It didn't. In 1940, he took his own life, broke and broken. Now, contrast this with someone like Warren Buffett, who we talked about earlier. Buffett isn't just good at making money, he's exceptional at not losing it. His strategy isn't about hitting home runs, it's about avoiding strikeouts. He focuses on capital preservation. He stays away from leverage and debt. He invests in businesses he understands. He doesn't chase trends. This is survival thinking, and survival is everything. Housel makes this point powerfully. Getting money is one thing, keeping it is another. If you want to build lasting wealth, you need to plan like a pessimist even while you dream like an optimist. That means building an emergency fund so you never have to sell investments at the wrong time, avoiding debt that could wipe you out if things go wrong, investing in a way that lets you sleep at night even during market crashes, never risking what you can't afford to lose. The goal isn't just to get rich, it's to stay rich, and that requires humility, caution, and respect for the power of risk. Here's a truth that the financial industry doesn't want you to know. You don't need a high income to get rich. You need a high savings rate. Think about it. You can earn $300,000 a year and be broke if you spend $310,000. Or you can earn $50,000 and become a millionaire if you save 30% and invest it consistently. Building wealth has less to do with your income or investment returns and more with your savings rate. But here's where it gets interesting. Housel argues that the value of savings isn't just financial. The real value is control. When you have money saved, you have options. You can quit a job you hate. You can say no to a client who doesn't respect you. You can take time off when you need it. You can pursue opportunities that require short-term sacrifice. Savings give you what money is truly meant to buy: freedom. Think about someone living paycheck to paycheck, even if they make a good salary. They're trapped. They can't risk changing jobs. They can't weather an emergency. They're one unexpected expense away from disaster. Now think about someone with 6 months of expenses saved. They have power. They can negotiate. They can take calculated risks. They can breathe. That's the real reason to save, not to buy things later, but to have flexibility now. Housel shares a powerful insight. Past a certain point, the only reason to accumulate more wealth is to have more control over your time. That's it. That's the end game. Not a bigger house, not a fancier car. Control over your time. The ability to do what you want, when you want, with who you want, for as long as you want. And you don't need millions for that. You just need enough saved that you're not forced into decisions you don't want to make. So how do you save more? It's simple, though not easy. Spend less than you earn and do it consistently. But here's the key. You don't save by being miserable. You save by aligning your spending with your values. Figure out what truly matters to you and spend generously on that. Cut ruthlessly on everything else. Love travel? Spend on trips, but skip the expensive car. Value time with family? Invest in experiences together, but live in a modest home. The secret isn't deprivation, it's intentionality. Here's where traditional finance gets it wrong. It assumes you should always be rational. Rational investing means invest in stocks for the long term, never panic sell, ignore short-term volatility, and trust the data. And mathematically, that's correct. Historically, stocks have returned about 10% annually. If you invest consistently and never sell, you'll do well. But the problem is, we're not robots. We're humans with emotions, fears, and psychological limits. Housel introduces a critical distinction: aim to be reasonable, not rational. What's the difference? Let me give you an example. A purely rational approach says, I'm young and have decades until retirement. Therefore, I should invest 100% in stocks because that will maximize my returns. A reasonable approach says, I know stocks are the best long-term investment, but if a 50% crash will make me panic and sell everything, I'll keep 20% in bonds so I can sleep at night. The reasonable approach acknowledges human psychology. Here's the truth: a good plan that you can actually stick with beats a perfect plan that you'll abandon the first time things get hard. During the 2008 financial crisis, the rational thing was to hold your stocks or even buy more. The market eventually recovered and hit new highs. But millions of people sold near the bottom. Why? Because watching their portfolio drop 50% was psychologically unbearable. They couldn't stick with the rational plan. If those people had invested more conservatively, say 60% stocks and 40% bonds, they might have only lost 30% instead of 50%. That might have been bearable. They might have held on. And here's the kicker: a 60-40 portfolio that you hold through a crash will outperform a 100% stock portfolio that you sell in a panic. The best strategy isn't the one with the highest theoretical return, it's the one you'll actually follow. This applies to everything. Should you pay off your mortgage or invest the money? Rationally, you should invest. The returns will likely beat your mortgage rate. But if having a paid-off house helps you sleep at night, pay it off. Peace of mind has value. Should you buy individual stocks or index funds? Rationally, index funds are better for most people. But if researching individual companies is fun for you and keeps you engaged with investing, maybe allocate some money to it. The point is, personal finance is personal. What's rational for someone else might not be reasonable for you. Know yourself, understand your psychology, build a financial plan that works with your nature, not against it.
Let's talk about one of the most important concepts in finance: margin of safety. Here's the idea. Assume things will go wrong, because they will. The economy will crash, you'll lose your job, medical emergencies will happen, your car will break down, your investments will tank. Not maybe, definitely. The question isn't whether bad things will happen, it's whether you'll survive them. This is where margin of safety comes in. Having a margin of safety means saving more than you think you'll need, investing more conservatively than you could, leaving buffer room in your budget, not maximizing leverage just because you can. Let me give you a concrete example. Imagine you calculate that you need $500,000 to retire. A risky approach is to save exactly $500,000 and assume everything goes perfectly. But what if the market crashes right when you retire? What if healthcare costs more than expected? What if you live longer than predicted? A safer approach is to save $750,000, 50% more than you think you need. That extra cushion is your margin of safety. Or consider your career. Maybe you're confident you'll always earn your current salary, but what if your industry changes? What if you get sick? What if your company downsizes? Building a margin of safety means living below your means so you can weather these storms. The people who survive and thrive financially aren't the ones who took the biggest risks and got lucky. They're the ones who planned for the worst and were pleasantly surprised when things went well. Housel emphasizes that room for error lets you endure long enough for the odds to fall in your favor. Think about it. If you're invested in the stock market with no emergency fund and you lose your job, you might be forced to sell stocks at the worst possible time to pay bills. But if you have 6 months of expenses saved, you can ride out the storm. You can keep your investments intact and let them recover. That margin of safety is the difference between success and failure. Here's the counterintuitive part. Having a margin of safety often means underperforming in the short term to overperform in the long term. If you keep 20% of your portfolio in cash, you'll miss out on some gains during bull markets, but you'll also survive bear markets without being forced into panic decisions. The person who goes all in might do better for a while, but the person with a margin of safety will still be playing the game decades later. And in investing, survival is everything. Here's something nobody tells you when you're young. You're going to change. The person you are at 25 is not the person you'll be at 40. Your values will shift, your priorities will evolve. What you care about today might be irrelevant tomorrow. This has huge implications for financial planning. When people make long-term financial decisions, they often assume their future self will want the same things, but that's rarely true. Housel shares his own experience. He went to college for a degree in a field he thought he'd love. He was certain about his career path. Within a few years, he realized he'd made a mistake. His interests had changed. This happens all the time. You buy a big house for a family you plan to have, then decide you don't want kids. You save aggressively for early retirement, then discover you actually enjoy your work. You sacrifice everything for career advancement, then realize family matters more. None of these are failures, they're just part of being human. The problem comes when you make decisions that are hard to reverse. Taking on massive debt for a career you might not want, locking yourself into a 30-year mortgage in a city you might not want to live in, building a lifestyle that requires a specific income level. These decisions assume your future self will have the same goals, but what if they don't? Housel's advice: embrace the idea that you'll change and build flexibility into your plans. That means avoiding extreme financial commitments that are hard to undo, saving more than you think you'll need so you have options later, choosing careers and investments that offer multiple paths forward, being willing to admit when something isn't working and changing course. This doesn't mean never committing to anything. It means staying aware that you're not locked into being the person you are today. The goal isn't to predict who you'll become. It's to maintain the freedom to become that person, whoever they are. Everything has a price, even things that seem free. And nowhere is this more true than investing. The price of investing in stocks isn't just the money you put in, it's the volatility. It's watching your portfolio drop 30% in a month. It's the sleepless nights during market crashes. It's the temptation to sell when everyone around you is panicking. That's the price, and most people don't want to pay it. They want the returns without the volatility. They want to invest and watch their money grow steadily, predictably, with no scary drops. But that's not how it works. Housel uses a brilliant metaphor. View market volatility as a fee, not a fine. What's the difference? A fine is a punishment for doing something wrong. A fee is the cost of admission for something valuable. When your stocks drop 20%, it's not a punishment. It's the fee you pay for long-term gains. It's the price of admission to the greatest wealth-building machine in the history. If you accept this, really internalize it, everything changes. When the market crashes and your portfolio drops, you won't panic. You'll recognize it as the fee. You'll know it's temporary. You'll understand that this is what you signed up for. The people who get rich from investing aren't the ones who never experience losses. They're the ones who accept losses as part of the process and hold on anyway. Think about it. If stocks never dropped, everyone would invest in them. The returns would get competed away. The only reason stocks offer superior long-term returns is because they're volatile, and most people can't handle that volatility. The volatility is the fee you pay to earn those returns. But here's the key. You have to actually pay the fee. You can't skip it. If you sell during a crash, you're not paying the fee. You're taking the fine. You're crystallizing your losses and missing the recovery. The only way to benefit from stock market returns is to pay the price of volatility by staying invested through the scary times. This applies beyond just investing. Everything worthwhile has a price. Building a business, the price is years of uncertainty and risk. Getting in shape, the price is consistent effort even when you don't feel like it. Raising kids, the price is sacrifice and worry. Success in any domain requires paying prices that don't feel good in the moment. The trick is identifying what prices you're willing to pay and then actually paying them without resentment, because nothing is free. The question is, what are you willing to pay for?
We're wired to admire the wrong things. We see someone driving a Ferrari and think, wow, they're rich. We see someone with a mansion, designer clothes, and expensive jewelry and assume they're wealthy. But here's what Housel wants you to understand. That's not wealth, that's spending. Wealth is what you don't see. It's the money not spent. It's the car they didn't buy. It's the vacation they didn't take. It's the humble lifestyle despite a high income. Real wealth is invisible. The millionaire next door doesn't look like a millionaire. They drive a 10-year-old Toyota. They live in a modest house in a middle-class neighborhood. They wear normal clothes and live a normal life, but their investment accounts tell a different story. Meanwhile, the person with the fancy car might be one paycheck from bankruptcy. The mansion might be drowning in mortgage debt. The lifestyle might be built on credit cards. We confuse spending with wealth because spending is visible, but they're opposites. Every dollar you spend to show people how much money you have is a dollar you no longer have. Housel points out that people's desire to signal wealth often prevents them from actually building it. Think about it. If you earn $100,000 and spend $90,000 trying to look successful, you're only saving $10,000. But if you earn $60,000 and spend $40,000 while living modestly, you're saving $20,000. Who's building more wealth? The person who earns less. This is why so many high earners are broke. They increase their spending every time their income goes up. They upgrade their car, their house, their wardrobe. They're on a hedonic treadmill that never ends. True wealth requires resisting this urge. It requires being okay with people underestimating you. It requires being comfortable driving past the luxury car dealership. It requires being confident enough to not need external validation. Here's the paradox. The people who look wealthy often aren't, and the people who are wealthy often don't look it. So what should you do? Stop trying to impress people with your stuff. Most people don't care anyway. They're too busy thinking about themselves. Instead, build real wealth quietly. Save and invest. Live below your means. Focus on financial freedom, not financial appearance. Because here's the ultimate truth. You can look rich or you can be rich, but it's very hard to do both. This might sound basic, but it's worth repeating. The most important financial skill is saving money, not picking stocks, not timing the market, not finding the perfect investment strategy, just saving money consistently. Why is saving so powerful? First, it's the one thing you have complete control over. You can't control market returns, you can't control the economy, you can't always control your income, but you can always control your spending. Second, saving creates opportunity. When you have money saved, you can take advantage of opportunities that others can't. When the market crashes and everyone else is selling, you can buy. When a great job opportunity requires a pay cut initially, you can take it. When you need to make a career change, you have runway. And third, and most importantly, saving gives you resilience. Life will throw curveballs at you. Medical emergencies, job losses, market crashes, family crises. The people who have money saved can weather these storms. The people who don't are devastated by them. But here's what's interesting. You don't need a high income to save. You just need to spend less than you earn. Ronald Reed, the janitor I mentioned at the start, never made much money, but he saved consistently for decades. He lived frugally, invested in dividend-paying stocks, and let compounding do its magic. When he died, he was worth $8 million. Meanwhile, people making 10 times his salary were going broke because they spent everything they made. The formula is simple. Earn money, spend less than you earn, invest the difference, repeat for decades. That's it. That's the whole game. Here's the final lesson, and it might be the most important one. You have to define success for yourself, not based on what others think, not based on what society expects, based on what actually matters to you. This is harder than it sounds. We're bombarded with messages about what success should look like. Big house, fancy car, prestigious job, expensive vacations. But what if that's not what you actually want? What if you'd rather have time than money? What if you'd rather have freedom than status? What if you'd rather have peace than prestige? Housel argues that the highest form of wealth is being able to wake up every morning and do what you want with your day. Not answering to a boss you don't respect, not working a job you hate for a paycheck, not sacrificing your present for a future that might never come, but actually having control over your time and attention. That's the real prize. And here's the beautiful thing. You don't need to be a billionaire for this. You just need enough money that you're not controlled by money. For some people, that's $1 million. For others, 500,000. For some, it might be less. The specific number doesn't matter. What matters is defining what enough means for you, getting there, and then stopping the endless race for more. Because if you don't define success for yourself, society will define it for you. And society's definition usually involves spending money you don't have to buy things you don't need to impress people you don't like. That's a recipe for misery, not success. So take some time to really think about what you want, not what you think you should want, what you actually want. Maybe it's retiring early. Maybe it's working a job you love even if it pays less. Maybe it's having time for hobbies. Maybe it's being present for your kids. Whatever it is, define it clearly. Then build your financial life around achieving it. Because money is just a tool. The question is, what do you want to use it for? So let's bring this all together. The psychology of money teaches us that financial success is less about what you know and more about how you behave. It's about acknowledging the role of luck and risk in outcomes. It's about knowing when you have enough and not moving the goalpost. It's about harnessing the power of compounding by staying invested for decades. It's about getting wealthy through risk-taking, but staying wealthy through humility and caution. It's about saving money not just to buy things later, but to have control over your time now. It's about being reasonable rather than purely rational, because a good plan you can follow beats a perfect plan you'll abandon. It's about building a margin of safety so you can survive when things go wrong. It's about accepting that you'll change and building flexibility into your life. It's about viewing volatility as a fee, not a fine, the price of admission for long-term gains. It's about understanding that real wealth is invisible. It's what you don't spend, not what you do. And ultimately, it's about defining success on your own terms and building a life that actually makes you happy. Morgan Housel's book is brilliant because it cuts through all the noise and gets to what really matters. It's not about fancy investment strategies or market timing. It's about human behavior, psychology, and understanding yourself. If you haven't read The Psychology of Money yet, I cannot recommend it highly enough. It's one of those rare books that fundamentally shifts how you see the world. And here's my challenge for you. Pick one lesson from this video and actually apply it this week. Maybe you'll calculate what enough means for you. Maybe you'll increase your savings rate. Maybe you'll stop trying to impress people and focus on building real wealth. Maybe you'll just remind yourself that market volatility is a fee, not a fine. Whatever it is, take action, because knowledge without action is just entertainment. Thanks for watching this deep dive. If you found this valuable, please hit that like button and subscribe for more detailed book summaries like this one. Drop a comment below and let me know, what's your biggest takeaway from The Psychology of Money? What lesson hit home for you? I'll see you in the next video. Until then, invest wisely, live intentionally, and remember, financial success is more about behavior than intelligence. Take care.